Welcome back. Today we're diving into a topic that could genuinely transform your long-term financial future. Imagine building a portfolio that steadily grows over time and has the potential to hit the $800,000 mark. Sounds amazing, right? While it's not something that happens overnight with consistent contributions and a smart strategy, it's achievable. And one of the best ways to get there is through a dividend-focused ETF, like the Schwab U.S. Dividend Equity ETF, ICR SCHD. We'll break down why SCHD is so appealing, how it works, what kind of returns you could realistically expect, and whether it's a good fit for your investment goals. Stick around, because by the end of this video, you'll have a clear picture of how a disciplined, long-term approach can turn regular contributions into substantial wealth. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Most investors are drawn to growth stocks or flashy tech companies with huge headlines, but SCHD takes a different approach. It tracks the Dow Jones U.S. Dividend 100 Index, which isn't focused on hype, it's focused on substance. Companies in this index are chosen because they demonstrate solid financial stability, strong cash flows, and a reliable track record of paying dividends. In other words, these are companies that may not make headlines daily, but are incredibly reliable over the long term. Think of it this way. CHD is filled with companies that are already proven winners in their industries. Over 19% of the ETF is invested in energy companies, and more than 12% is in industrials. Its top 5 holdings are Lockheed Martin, Chevron, Merck, Home Depot, and Bristol-Myers Squibb. These businesses aren't going to triple your money overnight, but they provide the kind of dependable income and stability that dividend investors value most. Another key advantage of SCHD is that its selection criteria naturally filter out risky yield traps. Those high dividend stocks that look appealing on paper, but aren't sustainable in the long run. That means investors don't need to spend hours researching individual companies. SCHD does that work for you, keeping your portfolio focused on quality. Now, let's get to the exciting part, the numbers. Since SCHD started trading in October 2011, it has averaged around 12.6% in annual total returns. Keep in mind, past performance is not a guarantee of future results, but for illustrative purposes, let's assume it continues to deliver roughly 12% annually. If you were to invest $500 each month, those contributions could grow significantly over time. Here's a rough breakdown. After 15 years, $500 per month could grow to about $222,600. After 20 years, it could reach roughly $429,300. After 25 years, it's almost $793,000, just shy of the $800,000 milestone. After 30 years, it could balloon to over $1.43 million. And if you stayed consistent for 35 years, you might see your account surpass $2.55 million. These figures account for SCHD's very low expense ratio of 0.06%, so almost all of your money stays invested and working for you. SCHD isn't just about capital appreciation, it's about steady income. Since inception, the ETF has averaged a dividend yield of about 2.8%, with the past decade coming in slightly higher at 3.2%. Let's assume a middle ground of 3%. If your portfolio grows to $800,000, that would generate roughly $24,000 annually in dividends. Think about that. $24,000 every year simply for letting your investment work consistently. That's money that could support retirement spending, supplement other income streams, or be reinvested to compound even further. The beauty here is the combination of capital growth and dividend income. It's like planting a tree that not only grows taller, but also keeps giving fruit every year. Even though we're making assumptions here, it clearly demonstrates the power of long-term, disciplined investing. Small, regular contributions can accumulate into a substantial portfolio over time, and dividends help accelerate that growth through compounding. Now, you might be wondering, should I jump in and buy SCHD right now? That depends on a few factors. First, consider your own investment horizon. SCHD is designed for long-term investors who value stability and consistent income over rapid short-term gains. If your goal is quick wins or speculative trading, this might not be the right fit. It's also worth noting that SCHD didn't make the latest list from analysts like the Motley Fool Stock Advisor for the top 10 stocks to buy now. Their focus is on companies they believe might produce huge gains in the next few years. SCHD, on the other hand, isn't about chasing explosive returns. It's about steady, reliable growth with dividend income. This is an important distinction. Growth-focused strategies can generate big, short-term wins but often come with volatility. Dividend-focused strategies like SCHD are about building a solid financial foundation over decades. If your priority is long-term security and passive income, SCHD has historically delivered on that front. Why might an investor prefer a dividend ETF like SCHD over individual stocks? For starters, diversification. With SCHD, you're investing in 100 carefully screened companies instead of putting all your money into one or two individual names. This reduces risk while maintaining exposure to high-quality businesses. Another advantage is simplicity. Dividend investing usually requires careful research to avoid companies that might cut their dividends. SCHD handles this selection process for you, giving you peace of mind that your portfolio is composed of companies with proven financial discipline. Finally, dividend ETFs provide a steady stream of income without requiring you to sell shares. Reinvesting those dividends can significantly accelerate growth over time, thanks to the power of compounding. It's a hands-off way to grow wealth while potentially generating an income stream for years to come. One key takeaway here is that consistency beats timing. Many investors get caught up in trying to buy low and sell high, or chasing the next hot stock. That approach is stressful and often less effective than steady contributions to a proven ETF. By investing a fixed amount each month, $500, $1,000, or whatever fits your budget, you remove emotions from the equation. You take advantage of dollar-cost averaging, buying more shares when prices are lower and fewer when prices are higher. Over decades, this method often leads to substantial portfolio growth. Patience is equally crucial. A portfolio like SCHD doesn't explode overnight, but it steadily compounds over time. By staying disciplined and letting the market do its work, you can potentially achieve impressive wealth accumulation with a relatively low-risk strategy. So let's recap. SCHD is a dividend-focused ETF that invests in financially stable, cash-generating companies with a long history of paying dividends. It's designed for long-term investors who want reliable growth and income. Historical performance shows it has delivered around 12% total annual returns since inception, with an average dividend yield of 2.8% to 3.2%. With consistent monthly contributions, it's entirely possible to see a portfolio reach $800,000 in 25 years, generating around $24,000 per year in passive income. And if you keep investing and reinvesting dividends for 30 or 35 years, those numbers grow exponentially. The takeaway is simple. Steady contributions, patience, and a quality ETF can work wonders over time. You're not chasing the next tech bubble or speculative hype. You're building a foundation that rewards discipline and consistency. Investing in SCHD isn't about instant gratification. It's about long-term results. If you're willing to commit, stay consistent, and let the power of compounding do its magic, it's possible to grow a substantial portfolio while earning a steady stream of dividends. Remember, the key isn't just the ETF you choose, it's your approach, consistency, and mindset as an investor. SCHD gives you a simple, hands-off way to achieve these goals with companies that have proven their reliability. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.